Hello, this is Mike Wade, Chief Options Strategist for Tom Gentile, and welcome to this video featuring Tom's tools and yours truly. Stock and options trading has large potential rewards, but also large potential risk. You must be aware of these risks and be willing to accept them in order to invest in the stock and options market. Don't trade money you cannot afford to lose. I'm not offering any kind of buy or sell recommendations on anything. Everything that I'm about to share with you is to be construed as education, not advice. All prices are in US dollars unless noted otherwise. Read the balance of the disclaimer if you wish by pausing the recording. All right, let's talk about naked puts. This is one of the things I used to do a lot of when I first started trading and I didn't know what I was doing. And I've since learned, of course, but this is an example of a naked put. So the idea of a naked put is that you can sell these things and get income and generate really nice high probability reward each month. So here's an example of selling a 245 put on Apple Computer. Now, of course, if you sell a 245 put, that gives you the obligation to buy Apple at 245. If Apple drops below that point, let's say it drops down to 200, you're going to have to buy that stock for 245, and that's going to cost you a lot of money. In fact, the maximum risk on a naked put at 245 with $4.15 of income, that's $415 total dollars for one contract. That's going to be your income, but your risk on a naked put, on this naked put, is over $24,000. Yikes, ain't nobody got time for that. Here's another way to do it. If you still want to generate high probability income, you could do what's called a short put spread, where you sell the same put, 245 put for $415, and then you buy the underlying put for $256. Now that's going to do a great thing to reduce our risk. You can see the risk has dropped from $24,000 down to $341. But here's the yikes part. You're going to have to spend well over half your original credit to buy the protection. So both are drawbacks. So how do we handle this thing? How do we get the benefits of a high probability short put without having to buy the insurance? So that's what I'm going to cover now. That's the system I'll share with you in this video. The bottom feeder system, selling short puts on bottoming stocks. So here's the agenda for this video. We're going to talk about the bottom feeder system. I've just introduced the need for it. I'll tell you what it is. I'm going to show you how to find really great bottom feeder candidates using the sell puts ranker in Tom's tools. The great thing about this ranker is that you don't need to even pass it any stocks. It knows how to find the opportunities all by itself. So it's a single ranker, really cool. And then I want to talk to you about how you manage these bottom feeder short puts as well. It's really going to be important for you to understand what to do in the event that these things go wrong. So let's talk about the bottom feeder system. Really the key of it is, how do you get free insurance? So on that initial slide I just showed you, we'd have to spend more than half of our initial credit to buy protection. That insurance is expensive. So how do we get that for free? Here's how you do it. Sell puts on stocks that are $5 or less. Then there's no need to buy any insurance. Zero is our insurance. That's our bottom feeder system. It's plain and simple. Just sell stocks that are bottoming out, that have dropped a lot. The benefits of those stocks is that the implied volatility is usually heated up and the options are expensive, and you can get some nice premium and have zero as your protection. Here's what I'm talking about. You could sell a $5 put on XYZ, and then you could buy the zero put on XYZ, but guess what? Zero puts are free. That's free insurance. So here's the deal. We're actually selling essentially a bull put spread without having to buy the lower put for protection. That's the bottom feeder system. The question is, how do you find them? Fortunately, Tom has an awesome ranker. First off, notice I'm back tested to October the 1st, 2019. So let's just go out and start searching. I'm going to go to searchers, single strategy, sell puts. This is the only ranker we'll need. First thing you want to do is set your stock list to all optionable stocks and indices, the entire universe of stuff that has options. I don't care what it is, whether it's a stock, an index, or an ETF. We want it. Click the Show Wizard criteria. And here's where we're going to select our bottom feeders. Make the minimum price 50 cents, the maximum price 5. Don't change anything else, including wizard criteria. Hit your search button. This thing is a fast search. Let's take a look at the results here. Again, we're on 10/1/2019. We're back tested. So what you see here is a stock symbol, various pictures. This first one's important. This one shows you the implied volatility compared to the actual stock price. This is what I was telling you. Stocks that are reaching for the bottom oftentimes have high implied volatility. That equals expensive options. That equals more credit, equals more profit. So in this case, we're selling a $4 strike with the stock price at $4.28. This is an out-of-the-money put option, 28 cents out of the money to be precise. Expiration date, price for the put, the credit, various other criteria. Make sure you keep your open interest at least 100. This first one on the list I like because it's at 4,500 plus. Delta, all the other things. We've got our put credit divided by close. That's a return on investment number. So 8.18% on this first one. Probability of profit is 65%. That's really good. And this ranking here, this probability of profit times ROI, is giving us a nice metric to sort by. This one is showing us a trade that's offering really nice highest, almost the highest, really it is the highest potential return on investment, and the probability is not the highest, but it's still a higher return on investment. So it gives you another option to rank. I like that because it combines the two. And look at the first one. This is going to be a November 4 put. We're selling a 4 put. We don't have to worry about buying any kind of 0 put or a put below it because 0 is our free put. Stock can't go below 0. That's our protection. Here's a trade that's offering really nice return on investment. You can see the risk graph. This is showing our profit anywhere above, really, at expiration, anywhere above this break-even line, which happens to be 365. So your cost basis in this is 365. If you choose to take the stock, then you can simply take it at 365 net, essentially. You could sell it and then move on to the next trade, or just do it again. And at the end, I'll share with you some ways that you can actually manage these trades in addition to just taking stock and selling the put again if the stock goes against you. All right, let's take a look and see what happens. So let's go to the latest date. That's going to be today, Halloween, 10/31. And at this stage, we've got almost our entire profit realized. We've got a 7.9% return. The option right now is worth about 6 cents, 5 to 6 cents. You can see here the stock's up here. This thing's about to expire. We've got 15 days left. You may choose to buy these things back for a nickel and take your profit. Now, of course, if you really wanted to make some money on these things, you'd want to do more contracts. But I'm just going to do one for the sake of example. So there you have it. That's the bottom feeder system. Let's talk a little bit before we close here on how you manage these things. So the first thing you could do is, if you get assigned, is to simply take the stock and then sell covered calls against it. That's an option. You could also roll your in-the-money puts at expiration, essentially kicking the can down the road and selling more premium as the stock does what the stock does. And then this is sort of like the conservative way to approach these things. If the stock closes below the short strike, then buy back your put. My personal favorite is number 2. I like to roll my puts. I don't like to take assignment and deal with stock. If you do that, you're going to have the amount of money to cover the purchase. So it's much simpler to buy the puts back, sell the next month's at the same strike price, and keep the ball rolling. So in summary, this is what you do to use the sell puts ranker to find bottom finders. You go into the wizards, you click the show button. That's going to pop up the criteria, change your minimum points, your minimum stock price, in other words, and your maximum stock price to 5. That's really it. And then make sure you select all optional stocks and indices under search stocks. Click search, and you are off to the races. All right, have fun with that bottom feeder system. I'd recommend that you paper trade it. It does have some risks. Sometimes stocks do go below 5, and sometimes they go close to 0. So it is possible to lose money on this system, but the probabilities are actually in your favor. So I hope you enjoyed that video, and I will see you next month.